Can you hear clearly? Can everybody hear clearly?
Yeah.
Is it much better if I take off my mask?
Yeah.
All right, well, I'll keep it off then. For anyone who hasn't seen me with this much hair on my face, surprise, I'm sure. Okay, well, thank you so much for everyone coming. We had huge competition, of course, with the World Cup. Canada playing for the first game in 36 years. So I'm very, very grateful. Great weather out here. And I'm particularly grateful and appreciative that you're here, especially likely when you hear the topic, because some of you may not know, but the Nobel Prize this year was awarded to, well, we'll get to that, but was awarded on the basis of solutions about the depression and the banking system. So instead of the World Cup soccer, you're getting depression and the banking system. So, as I say, it's all about the banks. And I learned a few things in doing this. I have not been a huge fan of banks. And incidentally, just a little background. I have a background in economics. I went to McGill. I'm also a writer. So I've got a couple of books of poetry and a book of short stories out. I started my own medical publishing company in the 70s, and it became really one of the largest medical publishers in Canada. Rogers might debate that, but I could give them a good argument. I had several publications. Medicine North America, which was a teaching publication. You got 36 issues that reviewed all of medicine. I published something called Parkhurst Exchange, which was a Q&A deal where general practitioners generally sent in questions and they were answered by specialists. The most popular magazine I did was Doctor's Review. It was a travel magazine, very successful for a long time until we stopped publication. It was the most popular magazine directed at doctors, with doctors in Canada. So that's a little background. I grew up in Montreal. We moved here 7 years ago, and we've enjoyed it immensely. So today, it's all about the banks. And the winners are Ben Bernanke, Doug Diamond, and Phil Dybvig. I knew I'd mess this up. Dybvig. Phil Dybvig, who is a bit of a strange duck, actually, but we'll get into some of that as we go. Ben Bernanke is one of the biggest overachievers I've ever read about. The man was destined for a Nobel Prize since he was probably 10 years old. I'm surprised if when they called, he may have said, "What took you so long?" Because here he was the chair, here who he is. So he was the chairman of the Federal Reserve from 2006 to 2014, a long period, and during the 2008-2009 recession, so very significant to the talk today. In 2009, he was the Time Person of the Year. He scored 1590 out of 1600 on his SAT. Not bad. He went to Harvard, of course, graduated Phi Beta Kappa, cum sum laude. He taught at Stanford. So if you want a Nobel Prize and you're an American, in fact, almost if you're anybody else, and you don't go to Oxford or Cambridge, you have to go to Princeton, Stanford, Harvard, MIT, and Yale. So he kind of hits them all. The other two are not bad either, but it's hard to shine when Bernanke is in the room. How he got his Nobel Prize, why he got it. he figured out the real cause of the Great Depression. Now, I'm sure most of you think you know the cause, and certainly there were a number of factors, but the real cause wasn't actually well known until he published his paper in 1983. So it took 50 years before it really filtered out what was the cause and the depth of the depression and why it lasted so long. So let's go through some of the things that we think caused the Great Depression, or at least may have been causes or were contributed to. So the first was the stock market, as we all know. In '29, they went south. Wall Street panic as stocks crash. The banks failed. This is a case of an American bank president standing on the steps of the bank in Yes?
Sorry to interrupt, but when you talk about the Great Depression,
Yes.
that is North America. Does that also reflect in Europe and Far East?
It did very much. It was all over the world.
Thank you.
And I thank you for that question because it fits very well with the next slide. The banks in the US failed, and in the UK and elsewhere, even in Canada. Now, this bank clearly was trying to do everything to save itself and paid off the depositors who were coming to collect their money that they didn't have. They seem to have even been selling the siding on the building. So it was a disaster. Industrial production fell by 17%, unemployment reached 25%, and through the entire period of the 30s it was over 20. So it was a true disaster. Things got very bad, as we all know. If we weren't there ourselves, our parents probably went through it. My father went around Quebec City, where he lived, with books in a wagon and ran a lending library. So we were all touched by it. And it was also an unequal unemployer. And this is a case where the signs here, the women, the single women are urging married women to go home so that the single women could have work. And that shows just a hint of the kind of social chaos that the Depression caused. It really disrupted the entire society so that groups that had formerly gotten along together and so on had trouble. There was resentment there was tremendous resentment over anyone who had money, if you were wealthy, so there was a poverty-wealth dynamic going on. And indeed, the wealthy just had far better standard of living than the poor, and the gap actually expanded. So we talk now about the 1%, and certainly they don't live like the rest of us. But the gap during the Depression was, in terms of what you consume, was far wider, and there were far more poverty-stricken people and somewhat more wealthy people. So there was tremendous conflict there. And everybody suffered. The kids, families, when the production fell by 47%, huge numbers of people were thrown out of work. Tens of thousands, millions were out of work. We'll get to some of those numbers. And the suffering permeated all of society. Children were particularly badly affected. Well, nearly everybody suffered. Not everybody. This is Bonnie and Clyde. They did okay. They did well for a little while anyway. And John Steinbeck wrote a book called The Grapes of Wrath. He won the Nobel Prize for Literature in 1962. And one of the reasons, this was, for me, The Grapes of Wrath was the emotional book that really captured the Depression. It was all about the Oklahoma people going out to the West Coast, a really heart-rending book. I was lucky enough in 1962, but before he got the Nobel Prize, earlier on in the year, to meet John Steinbeck. I was actually working at the airport in Montreal, and he came through by himself. I was a fan of his and of Ernest Hemingway, so I recognized him, and managed to spend about 10 minutes with him just walking to the gate to his airplane. So that was a tremendous thing for me. And he was surprisingly, I'm sure he was incredibly grateful to get the Nobel Prize, because he had a problem with Hemingway having got the prize, I think, in '44. And there was a sense that he thought he was not getting the credit he was due, that Hemingway was a star, and my God, I'm so grateful someone recognized poor little me, John Steinbeck. But of course, history, I think we were just, anyway, that was a little aside from the talk. The Depression also earned a postage stamp. This is this famous picture of Dorothy Lang took the picture, famous picture of Owens Thompson, that kind of characterizes the Depression. Can everybody hear still? Yes? Okay. So what caused it? There was the crash, there was the bank's failures, the dissidents, there were stock markets, the stock market margins. Sorry, I think that slide was out of order. This is another possible cause. Stock market crashed. And it was crashed mostly because just before the crash in '29, practically anyone who had 2 pennies to rub together was getting into the market. And they did it often based on loans from the stockbrokers, who were also clearly very involved in the market and playing it, so that you could put up $200, the broker would put up another $200. And it was incredibly widespread. There were millions of Americans who were in the market. The problem was that if the price of your shares went down, you had to match the margin. You had to match the difference between what you paid for them and what they'd fallen to. And if you didn't, the broker could take the shares over entirely. So when the market started to go down, huge numbers of people who thought they were well off and had stocks found that they were, not only were they broke, they owed big money to their brokers. And that was really the beginning of the cause of the run on the banks. So the other question was it the money supply? And after the Depression, a lot of people felt that the money supply, incidentally, is the total value of all deposits by all people in all banks, financial institutions, all companies, everything that they have, and all deposits everywhere. So it's all the money available to do things in the society, to fund industry, to buy your stuff at the grocery store, it's where salaries go, it's all the money. And the money supply in the 30s fell incredibly. It went down 30%. So there's if you took all the bank deposits everywhere, industry, everything, they suddenly fell 30%. And as a result, prices immediately followed and fell 30%. Are we okay? Do you have any questions about where we're going with this? Okay, so it wasn't the money supply, it wasn't the market crash, it wasn't the run on the banks. Was it the Federal Reserve? The Federal Reserve in the States is different than Canada. It has a central office in Washington, and then it has 8 separate regional offices across the country. And you sometimes hear on the news, they say, the Federal Reserve in St. Louis says blah, 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 interest rates are not a problem, or inflation isn't a problem. So what happened was they had them in Boston, New York, Philly, Cleveland, Richmond, Atlanta, Chicago, and St. Louis, and this disaster fell on the country, and they started arguing among themselves about what they should do. And they just could not reach consensus. So the society was torn, and the banking regulation people were also torn and fighting about what the cause was. And of course, how to fix it. What are you supposed to do about it? It actually wasn't rocket science. So I don't know, I don't particularly like Bezos, but I just thought it was a colorful slide. But the thing about economics and the thing about this particular solution, which we'll get into, an analysis, is it isn't rocket science. It's fairly easy to understand. You can understand why a bank crashes. If everybody came to get out their money on the same day, they wouldn't have the money. And if they didn't have the money, the people who couldn't cash it in would be incredibly upset, and that could lead on to different things. Or the money supplier, any of these things. But if you step back from it, it's very easy to understand what happened, of course, once you're told, or once you have someone like Ben Bernanke tell you. And the laureates, the three of them, really figured it out. It was always all in 83. They were relatively young. They were young. I mean, Bernanke was born in 53, as was Doug Diamond, and Phil Digvid was born in 55. So they're now in their 70s, but this is back in 83. They were young men, they were at their prime, which is often the case, and I suppose another reason why Bernanke might have said, "What took you so long?" when he got the call. So what was it? What did cause the Depression? Bernanke came at it from this point, that he wondered, why was it so deep, which I mentioned earlier? Why did it last so long? And why couldn't there be new banks that would pick it up? You know, a huge number, 9,000 banks went out of business. And why couldn't you set up new banks that could then take over? So that was the three things that Bernanke addressed. Okay, so banks are important. I'll go into this in more detail. But they're important because they channel depositors' money to loans to industry. The banks have a knowledge of who they're lending to. And when they fail, the knowledge is lost. And without access to loans, companies fail. And that, in a nutshell, is what happened. We can go into more detail. So banks take savings from a lot of people, and they then channel them to few companies or people, to few borrowers who they know from their experience are good for paying the money back. So that's how it works. And one thing to remember, and we'll touch on this again, is that banks suppose banks don't lend out all the money they take in, but they lend out a lot of it. So suppose they took in your $100, they might lend 50 or more of it to somebody else. And so they never really have more than 50, and normally it's much less than that. They may end up $60 or $70 of your 100 to somebody else. So it's not in the bank. But it hasn't, that particular service of banks is important to the general economy, which we'll get to. Because they're handling this money and they're channeling it from depositors to presumably good lenders, because they make interest on the money they lend out, they have to know their clients very well. And that is a key. No bank that doesn't know its clients, that doesn't know the people it's lending money to and understand them and have a history with them, really can succeed. So you need to have that knowledge, and that turned out to be very important in the Depression. Because when banks fail, all that is lost. Everything that they knew about never mind their savers, everything they knew about where their money went, where your money as a saver went, up to say 70% of it, unless they knew those companies well, had tracked them for years, kept track of them, but also knew the principals, knew who was involved, knew if it was a good company or a bad company. And that is essentially what happened. when the banks failed, they lost that knowledge. And so you couldn't just open another bank and suddenly start bringing in money and making decent loans. You just did not have the expertise. You didn't know how to do it. And that really was Bernanke's major contribution. Simply, they lost the knowledge. It wasn't that there was a crash. It wasn't that the money supply was short. It wasn't that people were out of work. It was simply that the loans that had been funding industry dried up completely. So companies that could no longer depend on loans, and most companies run on credit, whether you like it or not. They always have outstanding loans, and that's what keeps businesses going and growing. It took them 10 years to recover. This is a shot. You saw the earlier ones at the bank. This is in 1940. So the banks are back. But it's been a long, hard grind for everybody. And really, Bernanke's main point is it dried up because the banks did not know how to make loans, which people to safe loans, which people to fund, and so they didn't. And that was really the cause. And it took the intellectuals, took the economists really 50 years to really figure it out. In the meantime, many of us have thought it was other causes. So what could you do about it? Now you know the solution. What could you do about it? Well, meet two happy fellows. That's Douglas Diamond and Philip Dybvig. And they, of course, were the co-winners of the Nobel Prize with Bernanke. So who are they? They're good. They're deserving of a prize, but when you're up against somebody like Bernanke, you don't shine in quite the way. But anyway, Diamond, born in 53, he graduated from Brown and Yale, and he teaches at the University of Chicago Booth School of Business, which is the premier business school in the States, so he's no slouch. Phil Dybvig, I knew I was going to have trouble with this guy's name. He was born 2 years later, also an intellectual, went to Yale, got his PhD. He taught at Yale and Princeton, great. Now he's teaching at the University of Washington in St. Louis. So you say, one guy's heading the Federal Reserve and the other's teaching at the University of Washington in St. Louis. They're all very interesting and intelligent men. And Dybvig, I found it as much as I could find about Dybvig. There's Dybvig, but there's not a lot out there. He's a bit of a lone wolf. And talking about the phone call, getting the phone call. He was in Boston when they called, and he lives in St. Louis. So he had a tip for people who think they might win the Nobel Prize. Stay out of town, because otherwise they'll disturb your sleep in the middle of the night. So they also had a paper in 1983, and it looked at the banking system as well. And why not? 9,000 banks in the States, 9,000 banks failed during the 30s. It's a staggering number if you consider that today, Canada, and we'll get into that, has 85 banks, and 5 of them, just the top 5 banks, control 85% of the economy. In the States, now, today, in 2002, there are fewer than 5,000 banks in all of the United States. So that gives you some idea of the disaster of the bank failures. And remembering why they were forced to close. because of the run on the money, they didn't have, on the banks, they didn't have the money to lend out, and that knowledge of all those 5,000 banks was lost. So, we'll call them Doug and Phil, easier, looked at more at the weaknesses of the banks. So, and again, they fail because they have to have funds to cover withdrawals, obviously. As I say, this isn't rocket science. Yes, you're a bank, you have to have enough money to cover withdrawals. You have to manage loans responsibly, which we've talked about. And you must be careful not to put all your eggs in one basket. Because, for example, if a very large bank lent a lot of money to a cryptocurrency, it might be very bad news for the bank. So that was another lesson. So these are some illustrations from the Nobel Prize write-up itself. Run on the bank, we all know what it is. There's a rumor goes around, and Doug and Phil did look at this. Why rumors start and how they get going and the effect of them, because that's what happens. Someone says, gosh, I went to the bank on the corner today, and I needed to get $1,000 to buy whatever, to put down on a car, and they didn't have the money. So you're on the phone and start telling people that you better get down there and get your money, because, I don't know, they just didn't have it, I don't know why. And so that just goes around through a community like wildfire, and banks fail. The other thing is that a bank has to make clearly, and again, this isn't rocket science, they have to make more good loans than bad. You never have 100%. Banks always lose money on a certain percentage of their loans, but your success depends on you making good loans and making sure that the proportion between good and bad is kept as high as possible, that you have as many good loans and as few bad loans. Not rocket science. Now this is an interesting thing about banks, and I alluded to it earlier, and it's an interesting thing about the way they work. So the banks take in savings from a lot of people, and as I was saying before, they keep a portion of it and they lend out the rest of it. So if we're looking and talking about the money supply, you take your $1,000 and you put it into the bank. So you have a bank account that's worth $1,000. The bank then takes half of it, $500, and lends it to XYB company. So they now have $500 more in their account. You still have the $1,000 in your account, and they have $500 in their account. So in fact, the net effect on the money supply is to increase by $500. So banks actually increase the money supply. They increase the wealth of the country simply by that act of lending money to others. Are there any questions about that? That's a little hard to get your mind around, perhaps, but yes?
I just want to make a comment about banks, making the banks of England on a Friday night after they close.
Yes.
Monies in their accounts are taken and put into the Far East for a 24 or 48 period to earn money. It's done through the Bank of England. And it's the 5 central banks. I'm not naming the 5 banks, I can't remember them all, but it's all collected.
Yes.
And then I don't suppose they actually clean out the banks of all the cash over that period.
Right.
And with ATMs, that's probably made a difference. But they do move that money for a 24 or 48-hour period and then give it back for opening on Monday.
Right, and it's likely paid at the going interest rate. The money earns for the various depositors at the money.
But it does for the bank.
I'm not sure. Yes.
Not the depositors.
No, it goes to the bank.
Yeah.
Yes. I mean, that's the thing to always remember about the interest rate. We'll get onto it a little bit. But the interest rate is the overnight rate that banks pay when they borrow money from another bank, or the money they receive if they lend money to another bank. It actually doesn't have anything to do with consumer prices or any of that. It's a strictly banking calculation.
Yeah,
So,
my understanding is that these banks, the 5 banks,
Right.
whatever.
right,
Then, and it went to Bank of England. I mean, I had a relative involved in this as
Right.
well. And then the whole lump sum is put somewhere, as you say, for the overnight rate or the 2 overnight rates.
yes.
And then brought back into the
On
country.
the phone. Yes. I mean, banks are smarter than I think most of us. They keep their money moving. They depend absolutely on the interest. That's why you can get 2%, but they charge 6% to a company, or 8% on mortgage, or 7% on mortgages. That's how they make money. And it is all about interest, which is why interest is so important when it comes to trying to control inflation. So that's called maturation transformation, and that is how banks increase the money supply, by lending out portions of your money to other people, put it in their bank accounts. So, Diamond and Dybvig showed that these are the 3 points, just again. The depositors, they need to know that they can get money when they want it. And, as we all know, the longer you keep your money in the bank, the higher interest rate they're willing to pay, because then there's less risk that you're going to come and ask for it back in a way. So a GIC, for example, will pay a higher interest than a savings account. I have a huge problem with banks, to tell you the truth. I think that their fees are outrageous, and the spreads between what they pay depositors and what they loan the money out at is quite outrageous. But that is just a personal point, and I'm sure. And banks are incredibly important. They're essential to any economy. So I'm sure I would get a lot of arguments from any banker. But one can't help one's own biases. Now, also, Phil and now I'm even forgetting his first name. Sorry. Our boys, Doug and Phil. This is the Doug and Phil show. So they had insights in how banks should be regulated, and you have to monitor the liquidity, how much money you've got versus the risk of your loans. They are, of course, all in favor of deposit insurance. We'll get onto that a little later, but that's a government function where you're guaranteed whatever happens, the government will pay up to $100,000 of what you have in the bank in an account. So that's the Canadian situation. It's a little higher in the States, but a lot higher. So that was very important. It's a little complicated, but Canada didn't bring it in until into the 60s, but the States did have it in during the Depression at lower amounts. And stress tests, you often hear that they've done, or you may hear on the news that they've done a stress test at a particular bank. And what happens is the Federal Reserve, or the Bank of Canada, goes into the bank, looks at all their assets and their liabilities, so the money they've got, the loans they've put out, and then they come up with a number of scenarios about what would happen if there were recessions, what kinds of recessions, and how would it affect the bank, and does the bank have enough reserves to cover any unexpected costs arising, or losses arising from a depression. So that's what a stress test is. And they also, Doug and Phil, suggested that there are a whole lot of we're talking about banks, but there are a whole lot of institutions in the country that are semi-banks. They deal with money, they have depositors, they collect, but they're trust funds, they're mortgage companies, they're all kinds of other institutions, and they suggested strongly that they be regulated as well. So, thanks to the laureates, we were better prepared to fix the 2008-2009 recession, which was significant because, in a way, that's what all these two papers were about. What do you do if it hits again? And a lot of the the 2008-2009 recession was very, very different than the Depression, the Great Depression. Great Depression had the investments on margins, the stock market crashed, people ran to the banks, couldn't get covered. We've gone through all of that. But that didn't happen in 2008, 2009. In fact, it's a different kettle of fish. So I don't know, I couldn't resist having a different kettle of fish. But it does have something to say because it shows a shark. And there is no depression, recession, or anything else unless the sharks are around. And certainly in the 30s, the markets, the brokers, please forgive me, but were the sharks. They were trying to make money, excess of profits out of encouraging people to get into the stock market that really shouldn't have been in, that really couldn't afford to be in. So causes, we'll get into this in more detail, but this is just a quick summary. One of the things that happened just before the recession was that the government relaxed some of the rules that have been put into place to prevent the depression. So banks were allowed to make investments again and got into hedge funds and different things. The banks got into mortgages, and we'll get into this in more detail. They even started lending out on mortgage. Incidentally, just going back, yes, the cause of the 2008 recession, 2009, was mortgages. You probably remember that the mortgage market went strange. So what happened is, you heard at the time a lot about subprime mortgages. And subprime mortgages were mortgages on which you only had to pay the interest. You did not pay any of the principal. So it sucked a lot of people into taking mortgages that really couldn't afford them. And there were a lot of institutions out there who were ready to take advantage of this. So there was a lead up to it. In 2003, the Federal Reserve cut the interest rate from 6.5%, that's that interest rate that we hear about, to 1%. So suddenly, consumers could get money much, much cheaper. And they rushed into the housing market. And then these subprime borrowers, of which there were many, in fact, we had a mortgage at the time, and during the period, a new mortgage company took over our loan 3 times. So there was a tremendous amount of action out there. We fortunately had a fixed rate loan, so it didn't affect us. But home ownership, and I don't know if you remember, George Bush used to boast about how many Americans owned homes. And it got as high as 70%. 70% of Americans had a home. Unfortunately, millions of them could not afford them. So so they borrowed their money at, let's say, 1%. We'll just use those figures. But by 2006, the interest had gone up to 5%. And that's a lot. That's 5 times more what you were paying on your mortgage, even if you're only paying the interest, is suddenly due. And most people didn't have the money. What happened was, and we can all remember this, I hope we don't have friends that happened, but the prices of housing fell below what they owed on the mortgage. So you bought the house at 200,000, and suddenly the house was only worth 100,000, but you were paying 5 times the interest you've been paying before for a house that was worth half the price. That's in a nutshell. And it was, of course, a disaster. People just had to walk away. They could no longer afford to buy their house. And almost 4 million people in the States lost their money. Now, there was Lehman Brothers was a big bank in New York. And talking about the sharks, in a way, once these things start to happen, everyone is looking for some advantage. And what the big bank and the big banks on Wall Street had been permitted now, the rules had been relaxed, they could make investments, different kinds of things. So they started to buy up these mortgages, which were attractive to them because they were rated AAA. So, mortgage depends what you've got. But these mortgages were backed by good old Americans who had jobs and presumably could easily afford it. And the loan, anyway, even if they couldn't, the loan was secured by their house. So what Lehman Brothers and others did, they amalgamated these hundreds of thousands of these loans into different papers, and then they sold them out to other companies, often in Europe, to banks. So there was this paper that really suddenly was ranked as AAA, but was worth just about how much, just the same amount of the the people who lost money on their homes. So when Bernanke came along, he had to deal with this. And I remember at the time thinking how unfair this seemed, what he decided to do. Because there were 4 million people that had lost their homes, that were on the street, were trying to rent, had tremendous trouble. There was pain in the society. And what does Bernanke do? He puts a huge amount of money into the banks. In fact, he also did other things. He tried to stimulate the economy with tax cuts. He increased unemployment insurance and did food stamps. That's what he did for the people, but it was a pittance compared to what he did for the banks. And we just go back one. In 2009, he talked Obama into, or that's probably not the way to put it, but on his recommendation, the government put $800 billion into the financial system. I mentioned Lehman Brothers, they let it go, and I can only presume they let it go for the reasons that Doug and Phil had. When they looked at Lehman Brothers' package, when they looked at their total loans and assets, they determined that they were vulnerable, that they had bad portfolio, they had too much of these junk bonds, whatever, and they were unlikely to be able to survive. So they didn't rescue Lehman Brothers, they let it go. It's still controversial about whether they should have done it or not. But I presume that the stress test just made the company look very bad compared to Goldman Sachs and some of the others. But everybody was complicit in this. None of these banks were angels, that's for sure. But they did decide to support something called American Insurance Broker, AIB. They got, I think, 85 billion, and that was controversial at the time. Lehman goes under, and they rescue this insurance company. But again, they doubtless did it because Bernanke felt that it would be more of a disaster for the economy if the insurance company went under. So that was that. So that was what he did. And it always seems that, you know, those tax cuts would have gone to people, but a lot to corporations as well. And it can be puzzling in a recession why the guys at the top, the people at the top, the women at the top get the gravy, and the people in the street are kind of left hanging. They're left hanging, really, the reasoning would be, is if they don't save the banks, the whole system will collapse and they'll be far, far worse off. So it's better to save those financial institutions than others. So the Canadian system is not the same, although it is similar, but here's some differences. The Federal Reserve was set up in the States, and the Federal Reserve is an independent company. We won't get into that. It's not a government. It's not a government thing. It's actually owned by the banks. It's owned by the people who benefit from it. The Canadian system is owned by the government. It's the Bank of Canada, as the case is in Britain, I believe. So the Federal Reserve was set up in 1913. They put in deposit insurance in the Depression. It was one of the things. I'm not sure how much it was during the Depression. Clearly, it wasn't enough to save a lot of people. But now in the States, it's $250,000. So your bank account in the States, as long as you're an American citizen, they make a point that non-US citizens are not covered by deposit insurance. But as long as you're a citizen, you're protected by the government up to $250,000. In Canada, same sort of deal, but it's $100,000. Yes, so in 2008, a group of world companies and institutions decided that Canada was the safest banking system in the world. And the States had the largest system. We'll get into a little more of that. In Canada, the banks were allowed to merge in 1980, and they also allowed foreign banks to come into Canada in 1980. So we have quite a lot of foreign banks now. Canada has a branch system, so that there are only 85 banks, but as we know, the big banks, the 5 that we all recognize, we get onto those, have many branches. And Glass-Steagall was repealed in 1999. It was something they put in during the Depression to keep banks out of making risky investments, but it was repealed. And in the States, as I alluded to earlier, there's 85 banks in Canada, and there are almost 5,000 in the States.
Sorry, the branch system, 85 banks. Does that mean each bank can have 85 branches, or is it?
No, there are only 85 banks in Canada. They can have as many. They can have as many branches as they like, but we'll look at the next slide. We'll go to here.
You mean 85 physical banks?
Yes.
Physical buildings?
No. 85 companies that
85
are registered
banks.
as
Okay.
banks. So I don't know how many branches we have.
Right.
We'll look at it a little more deeply, but yes, banks, Canadian banks have many, many more branches than U.S. banks have. Not that U.S. banks don't have branches, they do. And this will be a little clearer, I hope, in just a minute. Where are we here? Yeah. So the Bank of Canada their overall mission is to have stable management and to control inflation. They regulate monetary policy. They look after the financial system to try to make banks are safe, sure, and others, mortgage companies or other institutions. One thing that the Bank of Canada does, that the Federal Reserve does not do, the Bank of Canada actually designs currency and issues it. That's done by the government in the States, not the Federal Reserve. And it supervises retail stuff, so charge cards, all the stuff that goes on in the retail field is also regulated by the Bank of Canada. The Federal Reserve's mission is to have maximum employment, price stability, and they conduct monetary society, the stability of the financial system as they do in Canada, and consumer protection and community development. And another thing to remember is that the Federal Reserve is owned by the banks that it regulates, whereas the Canadian one is a government operated. So 5 big banks. This will give you a little clearer idea of the US and Canadian system. So yes, there they are, and you want to know really where they are. The incredible thing is that those 5 banks, there's 85, there are 85 banks. 5 of them control 89% of the Canadian market. In other words, there are 80 branches, 80 other banks. They may have some branches, but they're not big by any means. So we should just, RBC's worth 142 billion. This is their market value. TD 130 billion, Scotia 93, BMO 62, and CIBC 49. So that's how big they are. And the top 5 banks, actually Goldman Sachs and they're the top 4 banks. Goldman and Morgan Stanley are not considered big banks. And the top 4 in the States have only 35% of the market. Of course, it's a much bigger market. So Chase 377 billion, Bank of America 310, Wells Fargo 260, Citibank 179, for a total of $1.12 trillion. So they're big. And we're nearly over. Just one more thing. Cryptocurrencies. They're founded on freedom, and they're founded on freedom. And regulation, I think, is on the way. Cryptocurrency is a very strange idea, but essentially it was not unlike what happens when you have faith in the bank. Somebody said, if we start to sell something, if a lot of people get in on it, it will have value simply because of the demand for it. Essentially, that's what it is. So they created all these people who started talking up the idea of having this thing. And as more and more people got in and started to trade it, the value went up. And now, as we know, one of the biggest companies failed. Simply because there was no regulation whatsoever. You could essentially do what you wanted with your money, and people did. So, quick summary, the depression, the problems that came up, the lessons that were learned. As a result, the recession in 2008, 2009, which was quite different, it was based on mortgages to, the depression, let's say, was initiated by the stock market, too many people buying stock on margins with money they didn't have. In 2008, it was all about mortgages. It was just the same deal. It was the sharks in a way. They said, here's where we could make some money. We'll give people mortgages and collect interest, and if they fail, we'll steal their house, we'll take their house, we'll foreclose. Whereas in the 30s, they said if they don't meet their margins on their stocks, we'll take the stocks. So not too different. And now we have cryptocurrencies. Clearly people rushed into it thinking here's a way of generating free money in a way, or at least getting our hands on money to deal with as we think should be done, not as some bank or institution or government thinks it should be done. And we're seeing it now start to wear away because, I hate to say it, because people at heart are greedy. And when you have the chance to grab cash and not seemingly have consequences, we do it. Human beings do it. So that's it for the banks and finances. So thank you very much. I hope that was somewhat clear. Are there any questions?
I just want to comment on the cryptocurrencies, because the one that's just gone under, I think some of the investors are suing a sports company or some sports league because they endorsed this company, and so that's going to be a pretty interesting case. And although I've got a load of questions, but I'll ask you because I'll bore everybody, so I'll ask you for everything. Except when you say money supply, do you mean printed money, letters of credit? I mean, what makes a money supply?
Yes, I wasn't clear enough about that. Yes, it includes all the currency, the printed currency that's in circulation, all the deposits in all banks by depositors or by companies, and any government money that's deposited somewhere that's sitting in an institution is included in the money supply.
Well, if you print money, like let's take Bank of Canada prints money,
yes.
It knows how much money is in circulation.
Yes.
How can it be lost? I mean, if it's simple stuff, let's say it prints 20,000 bits of money,
right.
How does that get lost in the community?
Right. Well, in the end, in the Depression, I think it was just that the prices fell, so that your money was worth a lot less. So you might still have the $1,000,
okay.
but it only now had a buying power of $500.
It's a value situation.
Yes.
Thank you.
Yes.
I just was wondering, right now, a lot of people are caught with variable rate mortgages, and so there are some defaults that are beginning to be seen, especially in the UK. And I'm wondering how you feel about the overall exposure of the banking industry. Looks like maybe they're going to get inflation under control, but if they don't, and all of these mortgages come due, have they been stress tested for that? Because there were a lot of people getting into the market, and it's not sometimes. You'll give a person a variable rate and you lend them at that, the rate that exists then. But do they look at the possibility of it going up by 4% and that loan still being a good loan? Do they stress test within the lender evaluation?
Yes, if they do stress tests, but they don't do stress tests on everybody. They'll do it on the big recognized banks, but if you're a mortgage lender in Reading or something, they may not do it. I'm not familiar enough with the UK banking system. But the other problem with it is the bailouts. The bailouts are a bit of a problem because it does give the system some feeling that the government, if things go bad, they'll get bailed out by the government. And that may encourage bad behavior.
Well, that leads me to the too big to fail idea, is that in a way with the Depression, the Great Depression, it was not that there was any one bank that was too big, there were just so many that failed. The reverse happened in 2008, where there were some don't know whether any economists are working on the theory of what's that sweet spot really, because,
I'm sure they are, but the more economics you read, the more you realize how it's a bit of a seat of the pants enterprise. You know, you go along and you look at the society and you do what you can. I mean, I do think that these three men did deserve it. They did come up with theories that were correct, and and there is a way now of, as we found, of mitigating disaster, but it's far from the final answer. The system is still loaded with places that are weak.
You go ahead.
Yes.
In the 1930s, my parents get a letter from my uncle who's living in the Soviet Union. They have been writing from the farm in Manitoba and describing the Depression. He writes back and he says, "What are you talking about? We have no idea. There is no depression." What was going on there?
Well, of course, half the graduates in Oxford and Cambridge were communists in the 30s, and with good reason, because they looked around seeing the collapse of the Western system. And communism on paper looks great. It's share and share alike, and all for one and one for all, and with the collectivization of industry in Russia, it looked as though there wasn't unemployment, but in fact the system was extremely weak as an economic system, because, as we have found over and over again, unless you have supply and demand, the economy doesn't regulate itself correctly. And there wasn't a proper system in Russia to regulate it. So you could encourage, you know, growing potatoes and encourage whatever industry you wanted, but eventually they would get out of whack. But certainly the intellectual feeling in the 30s in England and in many places in the States was that, you know, Marx had the answer to how to run a decent economy and how to encourage the greatest good. So,
But then when I read the letters and it describes their living conditions, they were worse than people living through the Depression here in North America. I mean, they were living in terrible times. And part of it was the collectivization and the dekulakization of the landowners. But
I think that is absolutely true. And then, of course, the whole system collapsed, and you realize, I mean, it was like you're making toothbrushes, and you have one plant that makes the plastic part and another plant that makes the bristles, and they don't talk to each other, so you end up getting, you know, too few handles and too many bristles or vice, and there isn't any other way that we've come up with of regulating the economy. So you can make things look good for a little bit for people. I mean, in Russia, plus the Russians, of course, started at a very low level in the 20s, so that, but yeah, conditions were terrible, and which even intellectuals from Oxford and Cambridge, when they went over to the Soviet Union later in the 30s, and then, of course, into the 40s and 50s, realized that it was not working. I don't know, not a very good answer.
David, one thing that strikes me in economics compared to the first three prizes this year, and almost all of them, is that, for example, quantum mechanics is highly predictive. It's accurate out to 10, 11 decimal places.
Right.
The same is true of general relativity.
Yeah.
The same is true of, say, the chemistry prize. The stuff they actually snap together and it works. But the trouble with economics is you're constantly looking back. I remember the 2008 recession, and what struck me in an amateur way, those days I used to get The Economist, and I thought, okay, we're in this trouble. Were people talking about this 6 months before, 3 months before? so I kept all the old issues, and I went through them. And almost no one, up to the break, was talking about what was coming. So in fact, it didn't have much predictive value.
No.
And I suspect a lot of it is because the economy is really very, very complex. There's a lot of information to process, and there really isn't a good system for processing it.
Well, that's true, and I suppose it's why the economics prize was the last one that.
Well, the
Nobel
last one
Committee
kind of
dared.
joined the other.
Right.
And there's also a problem there with the awarding of them. Why so many to the University of Chicago? I mean, at least the science prizes are kind of smeared around a little bit. But this really strikes me as the boys boosting the boys for relatively few institutions controlling where the prize goes.
Well, I think that's true. I don't know. Yes, the University of Chicago, Milton Friedman, supply
Yeah.
side economics and all of that, influential. And there is one from Chicago. But if you have a grandchild or a kid that you want to win the Nobel Prize, they have to go to Cambridge, Oxford, Yale, Princeton, Harvard, MIT, or Stanford.